Your strategy's optimization profile often reveals its robustness, helping you select strategies that remain profitable in live trading. I'll explain how you can obtain your optimization profile and how you can analyze your results.
Let's say you have a simple Donchian channel strategy where you enter the market on a channel breakout and hold the trade for a certain number of bars. You would have two optimizable parameters in this case, the Donchian channel look-back period and the number of bars in the market. If you simultaneously optimize each parameter in the 10 to 100 range, you will get the following plot. The optimizable parameters are plotted on the horizontal axis, while the performance metric is on the vertical axis. This is your strategy's optimization profile, which simulates your performance over the entire parameter optimization range. Each data point in your optimization profile is the backtest result for that particular combination of parameters. The optimization profile reveals your strategy's parameter stability. In other words, will it remain profitable when your parameters change? Robust strategies remain profitable over a broad range of parameters. Such strategies are resilient to changing market conditions, and are more likely to remain profitable in live trading. Ideally, you want to see an optimization profile with a high plateau, indicating stable performance across a wide range of parameters. Conversely, an overfit strategy will only be profitable in a narrow parameter range. Overfit strategies are constrained to random noise, which has no predictive value. Your historical backtests will be overly optimistic in this case. I'll grab one of my trend-following strategies and run it through StrategyQuant's optimizer. Here's the full strategy pseudocode. It captures breakouts by placing stop entries at the previous week's opening price. An ATR-based stop-loss and bar-based time stop are used for trade management. There are only two optimizable parameters: the ATR multiple for the stop-loss and the number of bars used for the time stop. After backtesting from 2003 to 2021, the optimal values were 3.1 and 154, respectively. This produced the following results. Was this just a lucky combination of parameters? The optimization profile will tell us. I'll configure the optimization range as shown. What parameter ranges should you use? Try to select values that are aligned with the premise of your strategy. For example, if you're a day trader, having a 200-bar look-back period for your indicator probably won't make sense. Likewise, for trend-following strategies where you should cut losses quickly, a stop-loss over 5 ATR is excessive. With the optimization range selected above, you'll get an optimization profile consisting of 5,986 different backtest runs. Now let's examine the results. Let's first do a visual examination. Here's a top view for clarity. The large stable region gives me confidence that the strategy has not been overfit. It makes sense that the most profitable region is where the stop losses are small and the time stops are large. You want to cut your losses quickly while letting your profits run. For simplicity, net profit was used as the performance metric. You can select other popular metrics like the profit factor or return over drawdown. Now let's look at some quantitative measures. First up is the percentage of profitable optimizations. This is an important metric for parameter stability. I want at least 70% of my optimizations to be profitable. Out of the 5,986 backtests, only 12 were losing, so I'm good here. Next is the average profit across all the optimization runs. If you want a metric that considers profitability together with robustness, this is a good choice. At the minimum, your average profit should be positive. I've got a $1,000 average profit here, which translates to well over 10,000 pips over the 18-year backtest. The uniformity of profit distribution counts how many times your profit flipped from positive to negative, or negative to positive. For example, in the sample distribution below, this happened 3 times. You want a small flip count, indicating your parameters are stable. This is related to the percentage of profitable optimizations, although the same percentage can produce distributions of different uniformities. Both profit distributions 1 and 2 above have 14 profitable runs. But distribution 2 has 11 flips, while distribution 1 has only 1. You want to see consistent and predictable patterns in your profit distribution. For example, having very small stop losses or time stops will result in overall losses. Profits will gradually increase as these parameters get larger. If you get something erratic like distribution 2, your strategy is likely not robust enough. For the strategy I'm testing now, there were 19 flips. This is a good result considering there were almost 6,000 runs. Finally, we look at the spread of the profit distribution. In StrategyQuant, the standard deviation of the profit is used to determine the spread of your profit distribution. Ideally, you want the highest profit to be within 2 standard deviations of the average. Here my highest profit of $1,880 exceeds the 2 standard deviation limit of $1,800. This is not necessarily a bad thing, since the trend-following strategy is designed to capture outsized wins. If you trade mean reversion with small profit targets, your profit spread should be lower. Robustness should always be emphasized during strategy development. There's no point creating a fantastic-looking backtest if your strategy doesn't perform in real time. Plotting your strategy's optimization profile is a quick way to evaluate your strategy's robustness. The visual and quantitative checks outlined above will help you remove overfit strategies before putting real money on the line. Be sure to support the channel by liking and subscribing, and stay tuned for more tips on robustness testing.